Welcome back. Time for your business update. AI fever is still driving markets to record highs, but Singapore's central bank says the hype could come with risks. Analysts warn that a sharp or sudden pullback in AI sectors could send ripples throughout the local economy. Nasyrah Rohim with more.
AI is now everywhere. Chips in devices, robots on factory floors, and it's now driving the latest global stock market rally. Singapore's central bank says markets are in relatively stretched valuations, especially in the tech and AI sectors. And if AI fails to deliver its promised returns, many firms could find it harder to repay investors and banks. Analysts say that markets could dive, and the spillover could affect jobs in the local semiconductor and electronics sectors.
There could be retreats, hopefully in an orderly fashion. It really depends what happens around that. So if these things happen on the back of a deterioration in trade tensions or geopolitical talks, you could potentially see a big correction in markets that would obviously have impact for funding and firms' demands and the economy.
Banks and financial institutions are also flagging risks from AI itself, like cyber threats and scams. They are also keeping an eye on the rise of stablecoins, digital currencies that expose investors to more volatile crypto markets. But geopolitical conflicts like the one in the Middle East and weak global economic conditions dominate the risk list for financial institutions. They are most worried about a possible slowdown or renewed inflation, along with tighter sanctions and fresh supply shocks.
External-oriented trade-reliant firms are exposed, given that they would be dragged by weaker exports in such a scenario where trade tensions re-escalate and tariffs may be imposed on other areas like, say, semiconductors. And here, trade-related SMEs are also exposed, given that they are less profitable than their bigger counterparts.
Mr. Chua adds that one key risk to watch is US tariffs. With electronics being such a vital sector for Singapore, the eventual impact remains uncertain, especially amid renewed talk of tariff hikes.
Singapore's financial system remains resilient, even as geopolitical risks and trade tensions have gone up compared to last year. The central bank says that's thanks in part to strong demand from technology-related investments. It also found most households could handle higher interest rates and lower income in a severe downturn, based on stress tests which model how the economy would hold up in tough times. Still, a very small number could struggle if pay falls and mortgage rates rise, mostly low-income households with little savings, as well as high earners with private housing loans. The central bank is urging them to build up savings and borrow prudently, just in case the worst happens. The same goes for smaller firms, which are considered particularly vulnerable.